Volatility is usually introduced as a warning, red days, sharp drops, headlines that make investing feel dangerous, even reckless. But volatility isn't a flaw in the market. It's not a sign that something is broken. It's a feature of how ownership works. And once you understand that, the market becomes far less intimidating and far more usable. Welcome to the solo investor. Volatility is movement. Prices rise, prices fall. Expectations shift far faster than reality ever does. And while that movement feels chaotic on the surface, it's the very reason long-term investing works at all. If prices were stable, there would be no opportunity, no mispricing, no reward for patience. Markets move because people disagree about value, about the future, about risk. Volatility is simply the record of that disagreement playing out in real time. The market doesn't reward certainty. It rewards those who can remain invested while uncertainty is on full display. Volatility isn't a flaw in the system. It's the mechanism that makes ownership worthwhile. It's the cost of admission. Market drops don't hurt because of the math. They hurt because of what they suggest. When prices fall, investors don't just see losses. They feel doubt. Did I buy at the wrong time? Did I misunderstand the risk? Should I get out before this gets worse? Volatility compresses time. It forces long-term decisions to be judged through short-term emotion. That's where most investing mistakes are made. Not because assets fail, but because investors abandon sound strategies at the worst possible moment. Every investor pays a cost to participate. For some, it's time. For others, it's discipline. For everyone, it's volatility. But volatility matters less when you understand what you actually own. If you see markets as tickers and charts, price swings feel like threats. But if you see markets as ownership in productive systems, volatility becomes informational, not existential. Businesses still sell. People still consume. Cash flows still move through the economy. Prices fluctuate faster than reality. Traders need volatility to time moves. Owners use volatility to evaluate value and conviction. Same market, different mindset, completely different experience. Market stress doesn't create weakness, it exposes it. Volatility is like the curtain drop in the market theater. Over-leveraged companies crack, speculation gets repriced, fragile assumptions collide with reality. This process is uncomfortable, but necessary. Without volatility, imbalances would quietly grow until the system failed catastrophically. Volatility is the market's pressure test, and for disciplined investors, it's often where clarity lives and opportunity finally appears. The hardest move during volatility is often the simplest one, doing nothing, not because nothing matters, but because your plan already accounted for uncertainty. Constant motion feels productive, but most wealth is lost through unnecessary action. Checking prices doesn't improve outcomes. Changing strategies mid-cycle rarely helps. Abandoning time horizons almost always hurts. Inaction isn't laziness, it's discipline. For smart investors, volatility isn't a signal to exit. It's a test of patience, a test of perspective, a test of whether you invested with intention or emotion. Markets don't reward comfort. They reward those who stay rational when discomfort shows up. Compounding has never been linear. Ownership has never been smooth. Stability has never meant stillness. Smart investors don't try to eliminate volatility. They build around it. They think in years while the market shouts in days. They prioritize durability over headlines. They understand that volatility doesn't decide outcomes. Behavior does. And once you stop treating every downturn as a verdict on your future, the market becomes less frightening and far more powerful. Thanks for watching. This is The Solo Investor.